Good afternoon, everyone. Thank you for joining us for what is sure to be a timely discussion on securing financial infrastructure. I'm Eleanor Terrett from Crypto in America, and I'm joined by some great panelists here today. You can see everybody's names up there. Well, they told me you would be able to. But yeah, so with market structure on the horizon, securing infrastructure and kind of figuring out the plumbing of crypto, as I like to call it, is going to be a very timely topic. So I'm excited to get into it with all of you and hear your perspectives and your takes. So I'll start with the closest, Fernando. Chainlink, your company, Oracle's, that's sort of your core to your business model. It's all about bringing trusted data on-chain through traditional systems, kind of bringing that onto the blockchain, right? And, how is that business model, working in, 2025 as we go into market structure and we're seeing, kind of the Trump administration and all this, excitement towards crypto and all this building and all this TradFi interest coming into the space. What are the positives and then also what are the setbacks that you're seeing towards, DeFi infrastructure? Give me sort of your 30,000-foot overlook to kick us off.
Absolutely. First of all, thank you for having me. The reason that we at Chainlink started with oracles is that back in the day, most of the data sources were, let's say, a bit unreliable. These data sources were not banks, were not broker-dealers, were in some cases DeFi protocols, so-called crypto natives, and you will see people, feeding you the grown data on purpose, right? That's where we came with the idea of distributed Oracle network. So we could do some curation, do some pre-screening, and make sure that, DeFi protocols, smart contracts were using data that you could trust on to basically come up with a risk score for an asset class or whatever that is. But we soon realized that that was not enough to transact on-chain safely. We saw that pretty quickly, that in different countries, right, people have different chains that they like to transact on. So you need, all of a sudden, you need to take one, tokenized asset from one chain to another chain. And then you realize that in many cases, these chains are completely different when it comes to really basic things like settlement finality, had totally different priorities, right? So how do you do that bridging in a safe manner? And so we did that, right? We come with a product that solves that issue. But we soon realized, that's not enough for banks and broker-dealers to transact on-chain, because we're trying to get them, to be more active in this space. And we realized that for banks, compliance was a big issue. In many cases, people were, using their MetaMask wallet, and they would transact on chain, and no one was, bothering with things like suitability criteria, which is something like a broker-dealer needs to look at, right? Because they are liable when they offer a product to a client. Again, that was not enough. What about the privacy? Many people don't want the rest of the world to see what are the stocks that they are trading. If you're an institutional player, you don't want your competitor to front-run you, because they can see all the stuff that you're doing. And this is just on the infra side, but it's also the way you access that infra. You're a financial institution or FMI, you better have a secure wallet. And unlike, in the early days where you could be a passive user of software, here in the DeFi world, where we're using blockchains where everything is distributed, ideally should be playing a role in the governance of the chain itself. Again, many FIs and FMIs are not ready to do so. So I think we'll see qualified custodians, the non-sexy, boring, players in this space, to play a bigger and bigger role. Because again, they'll be taking on that role of interacting with the chains in a safe manner. So I think these four areas, data, interoperability, privacy, and compliance are the areas where I see the most innovation, and we at Chainlink are focusing on.
Faryar, you guys just potentially took on a bigger role with being a qualified custodian with that SEC no action letter that came out a couple weeks ago that basically kind of gave investment funds under the Investment Advisors Act of 1940 basically relief that they weren't going to get sued if they used you guys or Gemini or any of sort of the crypto-centric custodians to hold their crypto funds. So potentially giving you guys a lot more responsibility. How are you guys kind of looking at that in terms of infrastructure, in terms of how you might navigate that going forward?
Yeah, thanks for the question. It's a really interesting dynamic that we have going on with the Trump administration. There's a number of things that are going on. Obviously, the focus that players like us and others have had has been to try to work with Congress to try to get clarity on the two big pillars of crypto regulation, one being stablecoins, which we were fortunate to get done with a big bipartisan vote with the Genius Act. And then the second is the market structure legislation, which obviously went through the House with a big vote, and we're waiting for the Senate to move forward. The interesting thing is that the Trump regulators have been extraordinarily forward-leaning in trying to provide clarity to the crypto sector, but then to move forward on tokenization in a way that I think a lot of us didn't fully expect. And so the clarification that the SEC did with regard to the, who qualifies as a qualified custodian is a really important step, because it was one of the measures that one of the issues that Gary Gensler had put into play in an effort to destabilize the crypto sector and to drive it offshore. I think the dynamic with the SEC, and it's true with the other regulators as well, but under Chairman Atkins, there's a really active effort on his part through his Project Crypto initiative to try to provide clarity to the industry in various different ways. And I think one framing point which Peter would find of interest, and people in the audience might find of interest, that I often will cite, is that what the Trump administration is trying to do and the regulators are trying to do is not to incubate the development of the crypto markets in the United States. What they're trying to do is to reshore crypto from having been driven offshore to bring it back into the U.S. And so as you think about the tempo of what the SEC is doing in terms of providing no action relief, guidance on a innovative exemptive framework, or a range of other sort of mechanisms that have been speculated about in the press or have been part of the chairman's public commentary, it's important to understand that their speed is very much of the essence for this agency. They're very much trying to take activity that's been moving offshore, including the tokenization of equities, for example, and to bring it back into the United States so that it operates by U.S. players under U.S. oversight, even if it's not subject to a securities regulatory framework, still to be occurring under, in the jurisdiction of the United States. And I think that's when you begin to understand what the president means when he talks about making the U.S. crypto capital of the world. So it's a kind of a long, broader answer to your question, but it's a really exciting development, and it's extraordinary to work with a set of regulators who understand that there's a competitive dynamic between the United States and other markets, and that there's an urgency to move. And Chairman Atkins is a perfect example of that with regard to the matter you talked about, but others as well.
Peter K., you spent a lot of time in Europe, and there's been some kind of question over whether MiCA has actually been as great in practice as it was in principle. Are there any lessons that you've seen there that, I guess good lessons, but more importantly bad lessons that regulators here could use, while they're thinking about crafting market structure, in terms of privacy and securing infrastructure, that they might be able to take away from anything that the Europeans use in MiCA?
I think the main lesson we learned, and I personally learned, is that we were right, or the European Commission was right in 2019, 2020 to make the call that crypto was the future, that blockchain, distributed ledger technology was the future for financial market infrastructures. That's why we set out to develop the MiCA regulation. Even though quite a lot of people said, why are you doing this? This is a waste of time. All of this crypto stuff is going to disappear. Crypto has no value, and so on. I said, no, we think that this really can transform financial market infrastructures. And we set out, and so far we've been proven right, because everyone said Bitcoin is going to go down to zero, Ethereum is worth nothing, and so on. And we see a very dynamic, very active trading taking place. Just like we wanted to onshore crypto activity in the EU, we now see that the US wants to do exactly the same thing. They want to onshore it in the US. And I think it shows that we are on the right path, but we shouldn't stop at MiCA. MiCA is not perfect, but it's pretty good, and it's quite comprehensive. It's much more comprehensive than the Genius Act because it covers both stablecoins and market structure, but it only covers the crypto assets which are not financial instruments. It's an important market, $4 trillion global market cap, a few $100 billion of transactions every day, but the future really is the tokenization of financial instruments, or the tokenization of real-world assets, as people call them. That market is huge. It's absolutely enormous. And the benefit, the efficiency benefits that can be gained there, but also the development of new products, of new ways of financing the economy, of raising capital, of capital formation, are so tremendous that this is an opportunity that no country, no self-respecting market can let go of. So if the US wants to become the crypto capital of the world, we in Europe should say, oh, not so fast, we want to become the crypto capital of the world, and let the best one prevail.
Do you feel that tension over there? Is there like a noticeable exit of capital or talent that came during the Biden administration that's now coming back because of the Trump administration to the US, would you say?
I didn't see much sort of talent moving, but you saw indeed companies being much more interested in developing Europe because we had a framework and we had legal certainty around. And now they're sort of saying, they were indeed sort of saying, well, look, the US market is going to be a bit problematic because the regulators are not as accommodating as they could be. Some said they were blatantly hostile. I'll leave that to everyone's judgment. And now that the attitude of the regulators has changed, you see that the interest in Europe is going down. The interest of US companies in Europe is going down. And that's not a good thing, in my personal view.
Interesting. Peter Curley, Ondo does a lot of work with institutions. Notably, I know you have a lot more clients than or partners than just BlackRock, but I think of BlackRock because I wrote in my newsletter this morning about Larry Fink going on CNBC yesterday, which I think has been talked a lot about today, but just, he's basically the evangelist for tokenization at this point. And, he talked about the repotting of TradFi into, the digital age. And I'm curious, as a company that is business model circles around tokenization, how are you guys preparing for that sort of wave of next gen, everything coming on chain? Perhaps if Larry Fink's vision comes true, all of TradFi tokenizing everything. What do you guys how are you preparing for that?
Well, thank you. And yes, Larry's certainly one of the better evangelists to have in your camp, and we appreciate him and others who are supporting the model we're talking about. As Peter referenced, it's a big market, and so it's going to take time to develop, but we are right in the middle of it, and it's an exciting time for us. For purpose of this panel, I think another observation is in terms of infrastructure, we're users of infrastructure. We're customers of people who are providing these types of infrastructure, and we have an interest in really all those things working well and seamlessly. And so one of the questions that comes up is it might be in terms of competition between markets or business models that might not work seamlessly together, is how is that going to look in terms of market infrastructure? And so we do think that it's useful to have some kinds of analogy, like where is this going? And the one I wanted to reference today was more like the Hawkeye technology, where it's used in sports now, with soccer or tennis or baseball, calling balls and strikes, et cetera, where the technology starts out as an aid to regulators and calling balls and strikes or like keeping things honest, but gradually becomes more ingrained in the systems over time because the accuracy means that people who are watching it in the stands even or through their television screens see, hey, like that's just right. We see it now. The technology allows me to see what the right outcome is here. I don't need the same level of human intervention that I might have needed in the past. So gradually it's like when the ref interferes, it's like, what are you doing? Like, I already saw that as an offside or a strike, and human participation becomes more of a bug than a feature. And I think we're right in that type of adoption curve now with a lot of these technologies. We have an interest, for all the reasons we're talking about, in really fully on-chain, seamless technology for the user experience. That's what we're building towards. I think that's what Chainlink, others are providing in terms of infrastructure. Regulatory environments and the different perspectives and markets are catching up. We're trying to see that. And we think we're at the point where that paradigm flips, where now more technology is better. We want to have more technology that aids the user experience, and people see, like, yeah, that's more fair than some of the human-based interventions that might have been true in the past. So we see that as kind of the direction of the market infrastructure and regulation is greater reliance on technology, but also greater confidence in the outcomes compared to a mixed system.
With some of those conversations that you're having, are these big institutions who may not be as familiar with on-chain activity, maybe some of the newer ones that are coming into the conversation who are like blockchain curious, are they nervous or worried at all about, sort of the nature of on-chain with like the permissionless blockchain systems? Or do you see a future where like they're all going to come on permissionless blockchains, or are permissioned and maybe even hybrid blockchains sort of like going to be still part of this future?
Absolutely. Like, people are very compliance oriented, and public permissionless blockchains is one of those features that they're most focused on as a difference maker in terms of functionality. So Faryar knows this very well. We did a little work together on this topic when I was at Coinbase. But the key here for me is that it's no longer, the competitive advantage in that space is no longer based on exclusion. In a public permissionless blockchain, it's the inclusion that becomes kind of the killer feature and app that drives both compliance and utility for the market overall. So it's almost like you're using compliance as the flywheel for adoption to drive costs of compliance lower by building the group of parties who are using it to a greater extent. So it's the ability, for my purposes, of building consensus that becomes that key factor, if you can drive that. And openness to the technology is a key factor. So I wanted to call attention to a couple of developments, particularly in England. So Bank of England being more open to considering providing services to stablecoins, for example, is a nice development. Change of position, we think, for the better. Sasha Mills also saying a number of very forward-leaning things in a recent speech. And we think examples like that are being noticed and driving conversations in the regulatory community in a helpful way.
Mm-hmm. Yeah, Faryar, I think you and I talked about this at State of Crypto like 2 years ago. I think we sat down and talked about these sort of the idea of a walled garden and how institutions were, eventually one day going to have to kind of come to terms with, sort of breaking that wall. But there's clearly still there'll be a market for maybe hybrid, maybe more permission blockchain still. But what's your take on sort of like where we are at this moment?
Yeah, it's a fascinating moment in terms of the investment that's occurring in the crypto sector. People are coming in with different types of solutions. You've got the big banks who were, I guess, implicitly on the side of permissioned blockchain infrastructure now, building and kind of providing services on permissionless public blockchains. You have some big payment providers building proprietary blockchains that they're offering to their client base as a tokenized payment solution for cross-border payments, and so it's a really interesting dynamic. It's like the early days of the internet, where we'll begin to see whether the internet or the intranet is going to be the prevailing technology. I think from my own perspective, I think part of what we're seeing, and Peter C. alluded to this, is that you're going to have a situation where people will have different entry points that they want to engage in with tokenization and crypto with, and some people will be comfortable enough to be able to maintain their own self-hosted wallet and transact on DeFi protocols on a peer-to-peer basis, and kind of own the opportunity of that, but also some of the obligations that come with managing your own value transfer ecosystem. And then others will want to use intermediaries, whether it's a big bank or a Coinbase or what have you. And I think what will evolve to eventually is one where people won't really see the infrastructure that they'll just want to take an action. And as Peter said, it kind of becomes ingrained in the experience associated with a particular type of activity, and they'll think less about it. I think the danger from a regulatory perspective is a lot of policymakers, not in the Trump administration, but you still see this on Capitol Hill, they still have an old paradigm of how to think about the technology, and you're particularly seeing in the debate on DeFi where there's sort of a sense of where we as the policy community are accustomed to surveilling and second-guessing people's financial decisions, and therefore we need to build that surveillance into software that enables peer-to-peer activity. And that's a hard one to break policymakers of. And in part, some of that is persuasion through what we say as an industry. Part of that is building products that people want to engage in on a peer-to-peer basis. But some of it is the courts ultimately deciding what the parameters of the Fourth Amendment are and the zone of privacy that people are entitled to in certain cases. And it'll be really interesting to see it settle out.
Can I have one comment? Actually, I see an interesting dynamic where FIs, including banks, might use a private permission chain for the payments leg, but they are okay with offering assets that are on a permissionless public chain. And so, again, I think one of the reasons for that is that in some cases the bank has their own, private blockchain. The way people do join their ecosystem, they really are into or trying to, offer tokenized deposits, but it does not impact their deposit base. So I get that, but still want to offer more products to the clients, and those products can come from public blockchains. So you end up bridging both. Many of us who started to do that are trying to figure out what kind of role they should be playing in the governance of the public blockchain that they start to interact with. And again, as I said before, I think you guys with qualified custodians will be playing a big role, because in many cases the bank doesn't want to go through the hassle of interacting with the public blockchain directly. So I would love to see how those roles are redefined for players like qualified custodians and other, so-called FMIs and market enablers.
Yeah, one thing I was just going to say is I think people paid a lot of attention to the attack from the Biden regulators at the crypto sector. The thing that didn't catch a lot of public attention, but we were very focused on at Coinbase, I know Peter Kerstens was very aware of this, is that you had the Basel Committee, the Bank for International Settlement, the IMF, a lot of the global institutions trying to build in a significant bias against permissionless public blockchains and public networks. The Basel Committee has 100% capital requirements that is still the Basel standard for any bank, globally active bank that potentially engages with crypto. That's an insane requirement, completely departing from the normal risk management prudential standards that Basel applies to any other sector. But we now have, like as Fernando was saying, kind of a multi-path option that banks and others are wanting to engage in. But we just averted a kind of government forced, permission, regulated, surveilled infrastructure that these global institutions were trying to force down on us. And I think people need to understand that.
I agree. Personally, I think that if everything's done and dusted, permissionless chains will prevail, and permission chains will become an afterthought, thought experiment. But I think that's why I personally believe that a few years down the line, no one will be talking about permission chains anymore. We'll see, but we should let the market determine what is the future. Regulators should not hardwire this into the regulatory structure, so saying, well, like, if you want to do certain things, if you want to use blockchains, they must be permission blockchains. Because if you don't use
a few years, how long are you talking?
Sorry?
When you say a few years?
A few years, well, I don't know, it's very hard to predict the future. There's no deadlines, but I'd say we'll be a lot wiser in 4 to 5 years. I think the race will have been run. And I compare this to an experience I had about 10 years ago when everyone was talking about cloud computing, and people sort of said, well, cloud computing, but for the financial sector, it should only be private clouds. And banks only wanted to deal in private cloud. A couple of years later, they said, no, public cloud only. We do not want private cloud anymore. And I think we'll see the same thing with blockchains. Now, I have nothing against permission blockchains. If people want to use a permission blockchain, knock yourself out. But permission blockchains do not have the same advantages as permissionless blockchains and the same potential. So I personally believe that permissionless will prevail, but it's not for regulators to dictate this. It is for the market to develop this and let the market determine what is the most useful outcome. And maybe we'll see a coexistence with the base layer being permissionless and all kinds of permissioning systems that you may need for certain applications in secondary layers and so on. Why not?
What is so different about a permissionless cloud than a permissionless blockchain in the minds of, regulators or indeed like big institutions, would you say? What's so scary about a permissionless blockchain?
Well, regulators always think about who can we hold accountable, who can we sue. If the chain is permissionless, there is no one to hold accountable. And they sort of said, we'd rather have a permission chain because then we can go after someone, we can hold someone accountable. And I think that is sort of 19th, 20th century thinking. The blockchain really upsets that. And the biggest challenge for policymakers and regulators is that we will have to come up with a new paradigm of how to regulate. Normally, in the financial sector, we regulate intermediaries. We have requirements, and these requirements are administered through intermediaries. They have to comply with the law. But in the future, we will still see lots of intermediaries, and they're fairly easy to capture in regulation. But you also see a lot of non-intermediated activity, DeFi. And you can't regulate DeFi with the paradigm of regulation through intermediaries. You can't regulate a permissionless chain through the lens of, we're going to hold someone accountable. So we'll have to come up with a new paradigm for policy and regulation. And I do not know today what that paradigm could be. That's why this is in a very exciting place to be in, because we can't predict the future. But I do think that the future will be bright.
I was building on that idea, Peter. I think we are searching for the paradigm right now. And there's some candidates out there. Their FMIs are using the system orchestrator as one type of thing where they're participating in the system but not dictating the outcomes in various forms. I think that idea still needs to kind of germinate a little bit more. But one of the key features there is that both regulators, participants have an interest in the open system and the results of the open system, the fairness and demonstrable fairness of them that's observed by all. If you can get to that where people aren't retreating to their walled garden as a necessary element to there, then I think we will have made some progress.
I know we are out of time, but just quickly, I want to go down the line and just ask, do you think we get comprehensive market structure done this year, yes or no? Fernando?
It's going to take a while. It's going to be a journey, but we are patient. Our time horizon is not 6 months or a year. But I think what needs to happen now is that we need to start building compliance and privacy at a scale. That's what we need to have actual global liquidity pools for cash on chain, tokenized securities in general.
Faryar?
I think the big thing that has to happen now is a couple of things. The U.S. has to go ahead get done with market structure legislation for sure, so that the developers have the confidence they need to innovate and build. But I do think the breakthrough will be on identity solutions. Having an identity, on-chain identity product that governments will recognize, which then will be something that financial services and other industry participants can rely on, will be a giant unlock for people to be able to engage on chain, because then once you have that resolved, then everything else can kind of flow from that, from a regulatory KYC AML perspective.
Well, having worked on many legislation, of course, in the European context, I've learned not to be driven by deadlines, and therefore I live in Brussels.
Neither is Congress.
I always say, and I think the US will do the same, it'll get done by summer. In Brussels, you never quite know when summer is, so it'll be done by summer.
And we also support sensible market structure legislation. We think they'll be additive to the marketplace and for companies like us to provide a nice reference point for us to do our business planning.
All right, give it up for the awesome panelists. Thanks, guys.